The number one reason for bankruptcy in America, medical expenses. The number one reason people pull money out of their retirement account, medical expenses.
So we want to talk about the health savings account. I know you might be like, that's not very exciting. Guys, this is an incredible tax strategy. It's a way to save on taxes. We all have medical, but there's also an incredible investment strategy you're probably not aware about, which is using an HSA to invest in assets you know and believe in. So we're going to talk about, how do I get money in an HSA? Why does that help me on my tax return right now? How do I invest it and grow it? And we got some incredible opportunities for you to think about. We're not just talking about putting it in a savings account or even buying a stock mutual fund or ETF. And then third, we want to talk about getting money out of that and accessing that, medical being one of the most common expenses you're going to have later on in retirement. We all have medical through our lives. So we're going to talk about actually accessing that and how we're doing that in a tax advantage manner as well. Here's what I want you to think about for the HSA. There's a triple tax benefit to the HSA. You get a tax deduction when you put the money in. As you invest it and grow it, you pay no tax as it's growing. Every penny gets to be reinvested and continue to grow. And then there's no tax when you pull the money out for qualifying medical. You don't need to wait till you're later at 59 and a half. That's at any age. And so it's called sometimes the triple threat.
Yep.
Triple tax benefit, HSA.
There's no other account like this. With the Roth, you have to pay tax, then put the money in. And then with an IRA or 401k, I get a deduction on the way in, but then I got to pay tax on the way out. So I get another two for tax-free, or should say tax-deferred growth, and then I'll pay tax later. But with the HSA, you get all three. And then another bonus, there's no AGI limitations. There's no income limitations. It does not phase out. It is on the front page of your tax return. I can't think of a better tax deduction for any American in this country that's on the front page of a tax return than the HSA.
So now let's hit some of the ways you get the money in. You can put $4,300 in a year. This is 2025 if you're single, $8,550 for those that are married. This is contribution in, a deduction on the front page of your tax return. Like Mark says, you don't have to itemize. You get this deduction on the front page of your return. Whether you take the standard deduction or itemize, you're going to get that. Now, to qualify, you must have a high deductible plan. So if you have a gold plan, for example, or if you have a Cadillac plan, a really nice health insurance plan, you can't do an HSA. Now, under the One Big Beautiful Bill, one of the changes was any bronze plan qualifies now as a high deductible plan. And there are some rules on that. Most plans, when you have them, they will say HSA eligible. Even here at our companies or our own employees, we have HSA eligible option and a health plan, or you have that's usually cheaper, or you have a more cover everything, lower deductible type plan, which is typically more expensive.
Yeah, and another way of approaching this insurance issue, if I may, is don't worry about these metals, bronze, gold, platinum plan, whatever. When you're shopping for insurance, whether you're on the state network, the federal network, or using an independent insurance agent, and we all three are alive and well in the country helping people get health insurance, just make sure it's a qualifying HSA plan. That's all you want to ask. Is this a qualifying HSA plan? For those out there that like a little extra info, that deductible limit has to be at least $1,650 if you're single, or $3,300 if you're married. Holy crap, I got to come out of pocket for $3,300 with my health insurance plan in order to have an HSA? Yes. Now here's the okay part. Most people don't even use their health insurance. And so if you're unhealthy, you're going to go after a different type of plan. But I think statistics are now 70% of people don't even tap into the full deductible, even with a normal HMO type plan. They buy health insurance for the catastrophic problems. Oh no, I broke a leg, or I have to have surgery, or a terrible disease, or some ailment. That's when insurance really should be there for us. And we overdo it. We're buying oftentimes health insurance we don't need. Just get the right type of plan and realize that you're putting away money in savings to cover the deductible. And if you don't use it, that money's growing for you forever.
Yeah, and those plans, you'll still have like office visits for smaller amounts and the copays. And so you're still getting that coverage and benefit there. And it's just for when you are coming out of pocket, you do have to hit those limits. Again, $1,650 single, $3,300 or so married. It's not that high of a deductible, actually. This is also, particularly for those that are healthy, HSA is an incredible option. You should be considering it for the tax benefits, but also for long-term growth. As we've talked about building wealth, one of the buckets of wealth that you should be building in addition to your retirement accounts, in addition to your Roth IRA, or your 401k or solo 401k for self-employed, you should have an HSA bucket. Like, in fact, we put that either number 1 or 2 on the list in priority. It's either the HSA or the Roth IRA that we're saying that is the first bucket to prioritize putting money into it because it has such an incredible tax benefit. As we said, it gives you the triple threat. It is the only one where you get the triple threat. Yep. Deduction, tax-free growth, tax-free distribution.
Yep. Now, a couple more thoughts on this first part of just getting money in there, because there's a lot here. Once you turn age 65 and are eligible for Medicaid, You can't open a new HSA. You can keep investing the one you started previously, but you can't open a new one or put new money in when you pass go every year in January. But whatever that bucket is, you can continue to invest it and pull it out tax-free whenever you want. Another thought about contributions is, I like what Matt brought up, is this strategy. The sequence for me is, any of you at work that have a 401k matching program, get the match. I mean, that's doubling your money. Now, it's only going to be 2 or 3% of your salary. Don't shoot for the stars on what you could put in the 401k. Just get the match. Double your money. Then get out and sit back and go, okay, where else do I want to deploy my savings? The Roth IRA and the HSA? Ooh, those two are going to be right up there in the second or third position. Then we're going to start looking at going back to the 401k, maybe putting in more. Maybe we're going to look at a rental property. With a strategic approach, you're really building these multiple buckets for diversification, asset protection, and this money is building for the number one cost that you're going to face in life, medical.
Yeah. A couple other things. If you're 55 or older, you got to put in an extra $1,000 a year. It used to be kind of clunky how you did this. That was one thing in the One Big Beautiful Bill that was fixed on this, where if you are married and have a family HSA and both of you are over 55, you can each put the extra $1,000 in. Before, you used to have to both go do single to do that, where you can double up on the catch up there for the extra $1,000.
You can put the $2,000 in now in a married plan if you're both 55 or older. Love it.
There you go. Exactly.
One other thing,
now, if one of you's only over it, then one of you can just do the 1,000. But if you're both over, you'll get the 2,000 into that married HSA.
Yeah, I love it. And one
I
of
should
the
say
things
family HSA.
Yeah, and one other thing on contributions that I think is important everybody knows, this is not a self-administered account. You're not going to just go open a bank account and say, oh, that's my HSA. This is the one where you have to use a third-party tech administrator that's going to manage this account for you. There's companies out there that will give you a debit card with it if you're going to put the money in and pull it right back out, which is fine. But for those who can let the money ride, we're going to come to part 2 here, which is investing that money, letting it go. So you're going to open an account. It does not have to be with the insurance company. It does not have to be with your employer. This is totally portable. You can take this account anywhere you go. As long as you have the right type of insurance, you can throw the money in. If your employer throws a little in, great. You can put in the rest up to those limits Matt mentioned earlier. So yeah, Matt, investing, this is your favorite part.
Yeah, this is the best part of it. And I think so many people miss this step is they think, oh, I've got this HSA and it's just sitting in a savings account at some bank making nothing. What are you doing? Like, you got to be engaged in this. You can invest that money. You pay 0 tax on the returns on that. And that comes out entirely tax-free to cover your medical, which, by the way, I'm going to tell you, don't pay your medical, reimburse it out later. We'll get to that in a second here. But as you're investing that money, I want to be focused on growing that, doubling it, tripling it. So you have a bigger bucket, because we know this is going to be a big expense. As you hit retirement, like long-term care, Medicare coverage that you pay for out of pocket, like you can use your HSA for that stuff. Of course, dental, there's so many things you're going to be able to cover for this during your lifetime, and that you can reimburse yourself backwards to, even the stuff that's occurred over your lifetime as you've had an HSA. So we want to get a big HSA at the end of the day. Now, let me just cut to the chase here. My HSA owns crypto. And you're like, wait, I own Solana in my HSA. You can own Bitcoin or Solana. You can actually, as an investment asset. Yeah. Okay. Now we have a crypto HSA, directed IRA, which is what we do here at our company, Directed IRA. You can own real estate and other cool things with your health savings account. So we're not just talking about investing in a stock. You could, or a mutual fund. You could. We're talking about investing in things that you believe in and think can grow exponentially to grow that HSA.
My wife and I recently bought a ranch that, you call it a ranch. It's a piece of land right now. You got to start doing stuff on it to actually call it a ranch, but we're trying. But anyway,
land with a trailer.
We bought a ranch, and it's in this little valley. We've gotten to know other ranchers and farmers, of course. You go down and hang out at the grill or the little cafe on Saturday mornings, Matt. That's the trick. Just want to give you a little pro tip there.
That's where you get
anyway,
really going on in town.
Yeah, we hit the county fair, the junior livestock auction, all those goodies. But anyway, I asked this rancher down the street, I said, hey, could I buy a few cows in your herd? Now, this was last fall, right before the presidential election, and the MAHA movement with the RFK was starting to gain more traction. Grass-fed beef, hormone-free beef, and a little more health-conscious beef consumption around the country, whatever. But he said, sure, it'll be on his land. He'll manage them amongst his other herd. And he's like, how many cows do you want? And I go, well, how much are they? He's like, well, you can buy a pair for about $3,500. And he told me how much he would charge to take care of them on the range and then in the fall. And we penciled it out. Patty and I combined our HSAs, created a little LLC. We have been contributing to our HSA the last 4 or 5 years. So we had 30 or 40 grand in there. And we bought 9-10 pair. So we have 20 plus cows. When we drive through the valley, we can look over and go, hey, those are our HSA cows. And hormone-free, grass-fed. And we could order already sell those pairs for about $4,500 to $5,000 right now, just 6 months later. Now we're going to go through the fall. They're going to fatten up to about 1,200 pounds each, those calves, and we'll sell them at the livestock auction in the spring. But we're going to have a 35% return on these cows inside our health savings account. How ironic is that? Maha meat inside a health savings account. We just think it's so fun. And that's just an example of getting creative. You could do notes, you can do loans, you can invest in a small business down the street in a neighborhood that you're excited about a business. Let your HSA participate in that. And all that profit is tax-free.
I think what we're talking about here is self-directing. If you're new to this show, we're talking about your IRA, your HSA, your tax advantage accounts. When you go and invest them, you don't just have to buy a stock or a mutual fund or an ETF. That's not the only investment options. That is when you have a brokerage HSA or IRA. But if you have a self-directed HSA, which you can open a new one, put new money in, you can transfer it from Fidelity or Health Equity or wherever your HSA account's at. You can transfer that existing money, your employer's health savings account. You can always move that money that's just sitting there, probably in a savings account or some mutual fund. You don't even know what it is. You can transfer that to directed IRA, invest it in crypto, invest it in, livestock, real estate, whatever it is you're interested in. These assets are available to you using a health savings account. And the goal here, of course, is we're going to grow the HSA. Those returns on the crypto, that goes back into my HSA. It grows it. The return on the livestock when Mark sells the cows, that's putting return and investment gains back into the HSA. The rental income on the property on his HSA, the gain when he sells it, that's building up the HSA account balance. There's no tax on that. You got to keep every penny back in that HSA. It's growing that balance. So you're having those funds available for your future medical. Now, of course, we'll talk about using the money here in a second. You can draw it out now if you want, but why not keep investing and compounding in that tax advantage account? Draw the money out later unless you really, really need it.
Yeah, before we hit this third phase, if it's all right, I'm going to give a shameless plug. If you go to KohlerBritCattle.com, you can pre-buy for a nominal fee the right to buy one of these 10 grass-fed hormone-free calves in the spring. And we've already got a handwritten waiting list, but we launched the website this week, actually. It's funny, Matt was the one that wanted to talk about HSAs, and I'm going, oh my gosh, I can talk about Kohler cattle. It's hard to find cattle to buy that you want to have processed and butchered and split amongst family or friends or neighbors, because these are like 600, 700 pounds of beef when you process a cow that big. So if you want to watch us on the live webcam and see the roundup, you can get to the Kohler Cattle Company website. It's going to be a lot of fun. So we'll have a link down there on the page too. So excited to build the value of the HSA so that I can pull it out when I want to, not when I have to. And this is an exciting thing because, Matt, I love how you've talked about this, and I kind of learned this from you, is that I don't have to go have a debit card to go to the doctor. I can just keep track of my medical expenses and then reimburse myself later. And gosh, I think that rule, you can collect those receipts for years.
Yeah. I mean, that's the nice thing about the HSA is, like, as long as you had the HSA, you don't have to pull the money out now. Let's say you have medical in 2025. You have $5,000 of medical and you're like, well, I could pull that out of my HSA and cover that. Why would you do that? Why would you take money out of a tax advantage account when you invest it and grow it and you pay no tax to go cover a medical bill? You already got the deduction when you put the money in. You're not paying taxes, you're growing it. Spending it out of the HSA is the last thing you want to do. Just pay for it another pocket of money. Pay for it out of your regular checking or savings account. Don't pull the tax advantage funds out. Now you might be like, well, then how am I ever going to get the money out of the HSA? Take it later. Let that money compound and grow in a tax advantage way where every penny of gains and investment returns you have, you get to reinvest with no tax. But the rule for HSA is, let's say 10 years later, you're like, well, now I want to draw some money out of this thing. I'm in retirement, or my income's down now, and I want to start drawing on this HSA. And now it's in 2035. Well, can I only take out just medical that I have in 2035? No, all the medical you had in the last 10 years, you just track it. You can pull it out 10 years later in 2035. That 5,000 in 2025 you had that you decided to let stay investing, and now that 5,000 represents 20 or 30 grand from all the investment returns and gains, pull that 5 grand out later in 2035. And so it's about being a little more strategic about it. A lot of our clients who are tax savvy take that approach where they're like, why on earth would I drain money out of this tax advantage account to cover medical? I got the tax deduction already when I put it in.
I love your example, but I will say, why in the world would you do it? There are a few listeners that don't have another pocket full of 5 grand. So they
obviously. Yeah.
So some people are like,
the other pocket, and I've done that. And I think that's kind of even my own HSA, when I was in my late 20s and 30s and I had an HSA, I only put money in to take it right back out. I had a $2,000 medical bill or something like that, or my kids needed braces. I put the exact amount into my HSA and I took it right back out because I needed the deduction. That's the way you have to do it. You got to launder the money that way if you want the deduction. But that was coming right back out. Then my mindset shifted because I'm like, I don't need to draw it out. I can start saving and investing my money. Would I do that in a brokerage account? No, use the HSA, no tax.
Yeah, it's so powerful. Now, let's answer what can you take it out for? This has actually gotten broadened with recent legislation, but let's just start with the baseline. IRS publication 502. It's got a great index and it goes through every possible medical expense: dental, eyes, physical therapy, chiropractic, prescription drugs, and everything that could or will not be allowed to be reimbursed. But the list is much broader than you may think. What you can pull it out for is just a laundry list. And in 2020, with the CARES Act, it allows now over-the-counter drugs and even teletherapy and all sorts of non-prescription expenses that you can get reimbursed through your HSA. That's really exciting because I would just make this recommendation, as Matt referenced. Have a spreadsheet somewhere or a file or a folder. If you're paper mindset or paperless mindset, whichever one it is, have somewhere where at the end of the year, you get a report from all the doctors or pharmacies you may have visited, maybe estimate what you spent at Walmart or Target on over-the-counter drugs, aspirin, Advil, Tylenol, whatever. Kind of do a little schedule. Here's what I spent in 2025. Just put it somewhere. Done. That's like a tax-free ledger that someday in the future you can just go grab it and done.
Yeah, and I think even with us at Directed IRA, we're not saying you have to use the debit card to spend it out. So many people are used to that. No, submit a distribution request. Tell us that it was for qualifying medical expenses, and we send you the money. We report it as that it was a distribution to you to reimburse you for qualifying medical, not taxable. Now, one big thing that happened in the One Big Beautiful Bill that was a buzzkill was they stripped out of early provision that said gym memberships would be able to be an expense in your HSA, and that was going to qualify as a medical expense. Sadly, in the final bill, that was snuck out. Thought it was a lame move because that would have been cool. Your HSA could have paid for your gym membership, which makes sense. We need to get people focused on that and a healthy lifestyle, but that was pulled out. So if you see any of the commentary on that, even my own videos or any of the stuff like that, just know that the qualifying medical expense for a gym did not make it into the final One Big Beautiful Bill.
Yeah, now there is some strategic planning here, kind of gray area planning. I don't want to say gray, just interpretive planning. Let me reference a couple other publications you'd want to consider. Publication 969. The IRS website has so many resources on this. Code section 213D, which is going to allow for long-term care coverage insurance. Your HSA can start paying for long-term care expenses or insurance. And there's a lot of case law out there. The tax court has said if a doctor prescribes a certain therapy, you need to go swim every day for physical therapy. There's cases, and we've had clients that have put in a swimming pool, one of these Michael Phelps type lap pools for physical therapy, and their HSA has paid for it or they've deducted it as a medical expense. That's something you need to work with your accountant on and make sure you understand the rules, and having a bona fide prescribed method of rehabilitation or
they call it
therapy, and it can be deductible under this as well.
Absolutely. Yeah, they call it letter of medical necessity. So if your doctor, physician, healthcare provider gives you a letter of medical necessity saying this is medically necessary for you for physical therapy, you could have where your gym membership is definitely something that you would be eligible for because of some type of illness or disease, or I don't know, it could be a weight issue even that could be causing some medical problems. So you can doctor then that it's not an automatic gym membership qualifies right now.
Now, what I love about this, Matt, too, I just want to add another interpretive issue, and that is service animals. The CARES Act did not specifically address emotional support animals as allowable medical expenses that can be reimbursed for through a flexible spending account or a health savings account. But there is clear guidance about service animals, therapy animals, guide dogs, hearing dogs, mobility assistance dogs, seizure response dogs, all of these types of animals that are specifically trained for a medical condition, tax deductible. Some people go, well, I've got to itemize, and then my AGI comes into play, and blah, blah. That's why you use your HSA. Put the money in your HSA, let the HSA pay for the service animal. That's another little loophole or workaround that's pretty interesting.
Yeah, and that makes sense. I mean, those dogs, those animals have cost to them, and that's part of your healthcare spending. And for those of you that have those medical conditions where you need that type of service dog, that totally makes sense. I love that little tip there. So let me just summarize here, of course, the HSA. We love it because you get a tax deduction when you throw your money in immediately on your tax return, you're saving money now. You can invest it in things you know and believe in. You can grow it. It doesn't have to just sit in a savings account somewhere you don't even know it's making nothing, or invest it in a stock or mutual fund. You can invest it in cool things you like. And for more ideas on what you can invest in besides stocks, bonds, and mutual funds, come to our Alt Asset Summit, by the way. That's October 16th and 17th, altassetsummit.com. From all these different things we've talked about, real estate, multifamily, oil and gas. Maybe we'll even have Mark Kohler talk about livestock.
This conference is so good. I really recommend to any of you that are looking for greater returns inside your retirement accounts than just a 5 to 8%. Maybe you get lucky with a 10%. After all of the administration fees, let's be real, the beauty of self-directing is administrative costs are oftentimes far, far less because there's not an investment manager over your money. It's you directing. Get the word self-directing where that money goes, and the ROIs could be incredible. So please come to that Alt Asset Summit either in person or get the remote link. It's every year. It's just awesome.
Yeah.
Patty and I walk around and go to the different booths, and it's been amazing what some of the people are doing out there investing, making money that we didn't know we could participate in with just our retirement accounts as a layperson, if you will.
Yeah. And it'll be in Scottsdale, Arizona. Beautiful time to be here, middle of October. Lots of other like-minded investors, incredible experts too speaking. So we'd love to see you guys there. Then the last tidbit, of course, on just this HSA topic is remember on getting the money out. You can use it for qualifying medical. We talked about a lot of the stuff that is qualifying, but you don't have to pull it out now. Let the money ride, right? If you have good investments and opportunities, let it compound and grow in that tax advantage account. Pull it out later when you do need the money to actually live on for your own lifestyle, or maybe because you've sold your business or you're not working anymore, you're in retirement, or your financial situation changes, whatever the case may be. But just know you don't have to pull the money out immediately when that medical expense is incurred.
I want to just say thank you to all of you, our listeners, that hopefully find us a little entertaining as well. We try to bring unique perspective to these topics. And I want to say thanks to Matt, who's really been a leader in this industry and helped so many people understand what they can do with their retirement accounts. And Directed IRA, the trust company, the team there is amazing. You can always get to the website, click on live chat, give us a phone call. Employees right here in the United States, right here in Phoenix, you're getting on the phone and talk with, and they're just great people too. So we would love to be of help to you. Please take control of your destiny and your future. It's yours for the taking, and you can do it even with your health savings account. Thanks so much for everybody listening, and we're going to see you next week for another episode of the Directed IRA podcast.